Welcome back. The SGX Nifty is indicating that we'll start with a cut and then we'll take it from there, down about 150 points. Gurmeet Chadha is joining us. He is the managing partner and CIO at Complete Circle. Gurmeet, hi, good morning. Thanks a lot for joining us. Let's start with some of these stocks which have outperformed, the likes of Mahindra and Eicher Motors. After the recent run, is it time to take some money home here, or do you think these stocks could continue to outperform?
Anil, my sense is I think you got to be selective here. On M&M, I think we continue to accumulate in our portfolios. 3-4 drivers. One is obviously they've been spot on the SUV trend, and I think they're headed for the SUV leadership clearly with back-to-back successful launches. Their production should pick up from almost 25,000 units a month to about 30 odd. And with improving, availability of parts and chips, and also with Scorpio adding another 4,000 or 5,000 units, there should be some healthy operating leverage. I think even the tractor business, which has seen like almost 3-4 months of slight contraction, while they have gained market share there, I think that should improve as we enter into a new festive season and better monsoons now, and also government initiatives. Also, I think the EV business currently doesn't figure in the overall valuations right now. It's too small, and they've just started with the first launch of the XUV400 platform, and they're cleverly again targeting the C segment in there, not the B segment where Tata Nexon has almost 85% market share. So I think better capital allocation, still about 17-18 times earning, not very expensive. So can still be added considering that the demand remains strong and we have festive season ahead.
Okay, it's been one of your favorite stocks, right? I think for the last 1 to 2 years, and now look at the rise seen. What about Britannia, Gurmeet? The management changes look pretty good. I mean, Varun Berry is now managing director. They have Rajneet Kohli on board. He comes with his Domino's experience. Would you put money afresh in Britannia?
So, Raj is a good friend, happens to be my neighbor as well. So very, very, very confident on his ability to steer things as he did in Domino's. I think Britannia also, if you see last 3 years in particular, post some hiccups in between, if you see that, volume growth has been around 10-11%. Last quarter also there was slight decline, but they had been reducing grammage, with better pricing points, and that would have, contributed. I think the total food company focus continues to be there. Also, I like the fact that now they are smart launching. They are doing while they are continue to gain market share in biscuits and other stuff. They've launched this Brisk Cafe, which is the snack with the coffee. In terms of the growing coffee culture, they're launching these 5 rupees cupcakes in East and other places. Also a couple of launches in wafers category. So I think innovation is the key here, especially when you are in this business, because the food business in general I'm very positive on. The other one which I've discussed multiple times is Tata Consumer. So I think Britannia should do well, and in an environment like this, where interest rates are going up, inflation is high, in general consumer staple companies tend to do better, and with raw materials also coming up.
Gurmeet, hi, good morning. Just a view on banks, which is probably the favorite, right? I mean, and there are indications credit growth is picking up. Things are on the mend for a variety of banks, smaller ones also starting to participate. What's your view there, and will the relative outperformance there start to come under a little bit of pressure, or you think should be okay?
Prashant, some under pressure is good actually, because it's been a one way on the bank Nifty. Now it's probably come below 40,000, especially the fall. So I think going forward, our calculations suggest that probably more than 55% earning growth in Nifty will come from financials, largely some of the top banks. So we continue to be constructive. Any fall is rational, as well as is good in terms of accumulating them. I think all three things are coming together. So not only the NIMs are expanding in the first stage, leading to better fee and NNI growth. Also, you see there'll be lesser provisioning. We are in a new cycle now with cleansing of balance sheet, deleveraging of corporate balance sheet taking place. Even look at some of the smaller banks which had credit costs as an issue, whether it is IDFC First or even Federal or City Union. City Union again is more trade finance. You will see there is a trend of declining credit costs. You see the restructured pool. Look at SMA1, SMA2 books. You will see there is a clear mend And when all three come together, and now with Treasury, I think also yields would stabilize in that 7.5% kind of a bracket. I think banks will do well. So we continue to, add the larger ones, which is ICICI, HDFC, SBI, in that order, and also look at selectively some of the smaller ones like IDFC First, where we are seeing after 3 years, a credible turnaround in credit growth, and now the legacy book is just hardly 4-5% of the overall loan book.
Okay, Gurmeet, just stay on. I do know that this is a space that you look at very closely, so I'm going to invite you